Hello, everyone, and welcome to the Sustainable Finance Podcast. My name is Paul Ellis, and I'm your host for these programs about developments in this fast-growing industry. James Kench is head of insurance at Kita, the company that insures carbon. He is a global finance, reinsurance, and climate risk executive with a career spanning Europe, Asia, and the Americas. Carbon insurance provided by Kita unlocks financing and de-risks projects in the carbon markets, a source of investment opportunity and potential liability when not insured. Carbon insurance contracts issued by Kita are backed by leading reinsurance companies like Lloyd's of London. Carbon insurance swaps the uncertainty of future losses with the certainty of insurance premiums to ensure transfer of contracts, unsustainable business models, and the cost of doing business. Carbon insurance can cover risk assessment, management, and risk-taking, and James joins us today to discuss how Kita improves financing and lowers the cost of capital in the carbon markets. Hello, James, and welcome to the Sustainable Finance Podcast.
Hi, Paul. Thanks for having me. It's great to be here.
Yes, it was really good to see you at the Greenfin 24 conference this week, and we had a good conversation there, and also got to meet Natalia. So we're rolling again, and we're going to get you on the podcast here, and we'll start with our questions. All right, so James, physical and intangible risks are two broad categories that apply to the carbon markets. Can you give our followers an example of each that Kita insures?
Yeah, sure. And just to frame that, like you said, in the context, our mission is how do we de-risk high-quality carbon projects and enable them to scale. And we think insurance is one of the keys to unlock that capital that the sector needs. We can bring that extra layer of due diligence and have third-party regulated risk specialists to give corporates and investors the confidence to act. So to do that, we look at what are the risks over the life cycle of a carbon credit, the different stakeholders, so the buy side, the sell side, the intermediaries, and the enabling of the system, and also different types of carbon project. And we're trying to build bespoke insurance products that solve some of the pain points for those markets as they scale. And by carbon project, we mean anything that captures and stores atmospheric carbon. So that could be the nature-based solutions, i.e. forestry that's capturing carbon through photosynthesis, or some of the engineered carbon removal technologies that use either a chemical or a mineral process like direct air capture, biochar, enhanced weathering, all those things. We need both of these routes to scale ASAP to meet our global net zero goals and start to slow and reverse climate change. But both of these types of projects can issue carbon credits, and the credits are a key financing tool. So we're trying to find ways to de-risk investments into those, and that will help the sector scale. The credits themselves are intangible assets, but as you mentioned, there's both the intangible and physical risks that affect them. Some overlap, but some are quite specific to each carbon project type. And there are folks out there that are looking to see carbon as a commodity, but the nuance, of course, with carbon credits is there isn't actually something that you can physically deliver. You can't really physically deliver carbon that's been negated like you could an oil contract. So in terms of the physical risks, these are kind of probably fairly simple and obvious. You have your natural catastrophe risks, so things like wildfire, pests, drought, disease, hurricane, floods, tornadoes, all those kind of nasty things. Those are kind of classic insurance type risks that we would look at anyway. You can also think of the underperformance of the project. So that could just be through poor execution, could be negligence, could be the insolvency or the abandonment of some of these projects by the developers. There are supply chain risks. In the forestry space, how do I secure a supply of the right types of saplings? In the engineered carbon space, how do I secure the feedstocks or some of the technology that these technologies need? Then there's some things like operational machinery risks, particularly for engineered solutions. Will they be able to scale up? Will they operate as efficiently as we need them to? And can they kind of gradually reduce their costs to become more and more scalable? So that's the physical risks. The intangible risks are a bit more nuanced. So that those are risks to the credits themselves and how they're measured. So how do we know how much carbon a particular project has captured. How do you validate and verify that? What standard, what methodology, what protocols do you use to measure that? And the risk that some of those rules may change over time. So I might think, day one now that my project's going to capture 1 million tons, but perhaps the science and the rules change over time to make that, gives me a haircut of say 20, 50%. There's the intangible risks around whether these credits are deemed permanent. Is the carbon that is stored captured for a long period of time? Obviously, with forests, they're at risk of being cut down or having a wildfire that then releases all that carbon. Or if I capture carbon and inject it into an underground aquifer, is there a risk of leakage? And then maybe some kind of political risks or regulatory risks that invalidate what the credits are valued at or how they can be used. So when we're trying to build these insurance products, we're insuring these intangible assets themselves, but we have to take into account both these physical and intangible risks at the same time. So we're trying to look at building products that protect buyers or investors that are investing in these projects, and they're putting money up front to receive a particular amount of carbon, but we cover the risk that they don't receive all or part of that carbon. We're also looking at protecting portfolios of credits against that reversal risk, particularly in the nature-based side, working with some developers and equity investors who are putting money into projects overseas against some of the political risks. And we're also building products around kind of classic credit insurance for lenders that are looking to lend to project developers, and also to project developers who they want to mitigate their own risks and be able to insure their own underperformance due to some kind of physical risk. But in all cases, the way our insurance works is that we can make an insured whole either with cash or in like-for-like carbon credits, depending on what they need for that particular purchase. So that was a bit of a whistle-stop tour there, but.
Okay. No, that's good. That's a lot of good information for our listeners and our followers to absorb. You use the term life cycle of a carbon credit. Could you tell our followers what that really means in terms of how that works in the marketplace?
Yeah, sure. So we see there are 3 main stages for the life cycle with 2 key milestones. So that the stages are like a concept phase, an execution phase, and then a retirement phase. And the 2 milestones are getting the project validated and then getting it verified and issuing credit. So basically, just to break those down, the concept phase is I'm a project developer or an investor. I think there's a way that we can capture some carbon. How am I going to do that? What investment is required? Where am I going to go do it? How do I apply to get the project checked and audited and get it validated, i.e. a third-party carbon standard will give the project the right to operate and say, right, we agree that this project is going to go out and capture 1 million tons. Off you go. Then that goes into the execution phase. Actually, planting the trees, growing the trees, or implementing the technology and capturing the carbon through an engineered process. And then once that's done, before the credits are actually issued, there's a second kind of audit just to check. Well, you plan to do this. Have you actually done that? How do we record and measure what has been done? And again, that's through a third-party analysis and via these carbon standards, who will then issue the credits. At that point, they become sort of tradable instruments, either for in the secondary market for folks to kind of speculate on, or actually for the end users, i.e. the corporates that want to use credits to offset against their hard to abate emissions as part of their net zero strategy. When they use those credits, then they would be retired and then they can't be used anymore. So that's the main life cycle. We think most of the risk is in that pre-issuance phase. So concept, execution, getting the investment, actually getting the work done. And that's where we focused our insurance products to date. Okay.
So now let's, again, you've mentioned another term that these carbon credit contracts do become tradable once they're once they mature, or there's a process of time where they become tradable in the marketplace. What is the financial impact of managing risks effectively in the high quality carbon markets?
Yeah, good question. And I think you mentioned it at the start there. We think insurance has a key role there to help assess and price the risks, and then we can provide, risk mitigation, risk transfer tools for the corporates to take more action. And unlike what you said, we use that line a lot. How do you swap the uncertainty of future losses with the certainty of an upfront insurance premium? So their insurance is there to manage the volatility, so protecting against low frequency, high severity events, and provides that downside protection. Also can act as a risk pricing signal and a risk indicator. So if a project is insurable, then hopefully that means it's also bankable and can unlock that financing. Then that financing, if there's insurance involved, can be on better terms since the counterparty risk, that project developer who are all trying to do great stuff, but they're generally early stage companies, limited balance sheets or limited kind of track record. The insurance can step in and swap that sub-investment grade credit risk with the credit risk of a AA rated insurance carrier. And that helps to lead to a lower cost of capital, and therefore, all allows corporates to take more risk. They can also look to lock in supply, lock in preferred pricing by forward purchasing or doing upfront investments for a streaming structure, knowing that there's a sort of an insurance wrap around that in case the project does fail for some reason.
Okay, now carbon insurance, like any other type of forward payment contract, has a risk and credit management cycle. We've talked about this a little bit. Can you give our followers a couple of examples of carbon market credit cycles that Kita has insured? No names, of course, but a couple of examples of how this actually works.
Yeah, sure. So the cycle is that those phases that I mentioned just now. So we're seeing a lot of investors putting money into really, really early stage projects. One, because they want to lock in the supply of credits and also to lock in the price. I think the general perceived view of the markets is the price of carbon is going to increase in the future because there's going to be increasing demand. There's really quite a constrained supply right now of high quality projects, which is going to be only exacerbated in the future. So we're working with those investors, putting money into a project now, either via a prepayment or via some equity investment that are looking to get a future stream of credits and protecting against that the risk of non-delivery. So I've prepaid for something. Am I actually going to receive that carbon? We're also looking at the reversal risks for credits that have been issued. And we just launched a product actually just this week for the carbon standards who maintain buffers. So it's a sort of self-insurance mechanism for the carbon markets themselves. We launched a product to provide protection against depletion of their buffer pools. So if there are lots of projects around the world that have all contributed to these buffer pools to maintain the integrity of its system, what if one really large project has a complete loss, or many projects have lots of sort of small to medium losses that start to cumulatively impact that buffer? Also working with the investors looking to protect against some of these political risks. So if I'm putting money into a project in, say, the global south, there might be a risk that the host country either nationalizes the project or they might cancel any licenses that project developer has. Or going a little bit more into the weeds in the carbon space, some of these countries will provide what's called a corresponding adjustment to the credits that are issued. So there's a risk that the host country either won't provide those corresponding adjustments, or if they provide them, they'll revoke them due to sort of some change in policy on their front. So those are some of the risks that we're seeing. So it's mainly lots of commodity traders, some of the oil and gas firms that have trading desks, specialist carbon funds, specialist asset managers. They're the ones who are the most active we see in this space, as well as the sort of mega large corporates that are buying direct, and they have the in-house resources to do what is quite a lot of research, due diligence of screening these projects, structuring the investments, and finding ways to mitigate risk. But all of this is kind of working towards building a bit more maturity and robustness in how these contracts and these projects are structured, hopefully making it a lot more repeatable and sustainable for the market as it starts to scale.
Okay, now I'm going to ask you to walk us through the life cycle components of a carbon insurance contract that Kita has issued from start to finish. You've given us some broader perspective, but let's just take a particular insurance contract. And it could be, I don't know if you're actually issuing the new buffer contracts yet, but whatever you think will help our followers get more clear about what we're actually focused on here. Good.
Yeah, sure. So I mean, a good example is the non-delivery insurance, so protecting investors putting money into projects upfront. As you can expect, they don't do that lightly. There's a ton of due diligence, lots of screening. So it can take for them several months to structure those investments. Our insurance can be activated, can be bought after investments have been made, but we're always keen to encourage folks to engage with insurance early, because then we can help give our view on, well, do we think a project is insurable? Are there any ways that we can mitigate some of the risks upfront and reduce that risk both to them? And if we can, then that also means that the overall project risk is lower, which means that our insurance can be more competitively priced. But in terms of the main phases, there's again that kind of scoping phase. So how do they structure the transition? How do they optimize risk mitigation? How do they build more rights of recovery, rights of recourse into the contract? Then there's the inception phase. So they purchase the policy after having worked with us. And our policies are multi-year. So we can do a maximum of 10 years for one policy. So that those terms are set up front, but there is some scope to adjust those terms throughout the life of the policy, perhaps if the investments amounts have changed, for example. But I think one key value add for us on the insurance side is we do ongoing monitoring. So it's not just set it and forget it. You know, we've got a vested interest to see how this project has performed once it's insured. So we'll be tracking it both as part of our due diligence before the event of, what are the physical risks? We have all these remote sensing feeds. And then throughout the life of the project, we'll be tracking, is there forest canopy growth as expected? Are there some, wildfire risks or, evidences of drought or disease, etc., or land use change? And then the value there is that we can help to work with the insured to identify these risks and see if there's a way to get the project back on track, or if not, is there a way for us to accelerate a claim if there's been a clear loss event? If the half the forest is burnt down, then it's fairly obvious that there's going to be an issue, and that the insurance can come to step in. Which and that leads me to think about how a claim works. So for us, we wrap our insurance around expected delivery dates. So
okay.
As I mentioned at the start, you have these third-party kind of auditors that will review projects on a regular cadence to say, well, you said you were going to do this. Have you actually done it? And actually measure and verify that it's okay for the credits to be issued. We tie our insurance to those delivery dates, but we'll also look to see whether there's been a major event at any point before that. But if it's clear that there has been an under-delivery or a non-delivery, we'll work with the parties to see if there's any way to resolve that under the terms of the underlying contract. And then if not, then we'll come in and look to adjust the claim and then calculate what the loss has been, and then either have the ability to pay the claims in cash or in like-for-like credits. And then if the insured has elected to take like-for-like credits, then we have a best matching exercise to try to fill the order based on the criteria that's most important to that insured. So everyone has a slightly different reason for why they're buying credits and what types of credits that they value more than others. It can be a geographic preference, a type of project. It can be things like the community benefits or biodiversity impacts, or things that are emerging like credit ratings for carbon projects themselves. And then the key one is always the additionality of a project. Is the investment into this project that's creating a stream of carbon credits, would that have happened without this kind of type of investment? So there's a ton of different attributes that are of value. And that's one of the challenges in the carbon space, where I think the financial markets want it to be seen as more of a commodity, but at a kind of project level, they're almost like individual securities with very different risk profiles and very different values for different buyers.
Now, James, it seems to me that it's only in the last several years where we're really focusing on the voluntary carbon markets, which is primarily what we're talking about when it comes to Kita's insurance contracts, right? There's been an explosion in growth in the focus on these markets. What's Kita's perspective on the growth potential of carbon insurance as companies of all sizes begin to meet the regulatory carbon reporting requirements that the EU and the US are now coming out with, and eventually will be required all over the world? During the next 5 years, what do you think the growth potential of this whole system is?
Yeah, that's the $1 million question. I think we at Kita, we're very bullish on the potential of the carbon markets in the future. I think the key question is just when, not if, it's going to scale to the various forecasts. The long-term forecasts for carbon markets are that it could be a sort of $1 trillion market annually by 2050, and that's by virtue of a function of by 2050 we need to be removing 10 gigatons of carbon per year, and with an expectation that carbon might be trading at $100 per ton. That gives us a $1 trillion annual credit issuance kind of volume. To get there, there's going to be tons of investment in terms of the actual project. But I think the unknown is how quickly some of the regulatory drivers that you mentioned are really going to push us to get there. From the insurance standpoint, that $1 trillion sort of TAM, as it were, in 2050, we think that could equate to about a $10 to $30 billion premium market. So ensuring the assets and liabilities around the credits that are being issued. But just the unknown is the kind of speed and the shape of that scale-up curve. We think on an interim basis, maybe by 2030, that could be $1 billion insurance market. So aligning to some of the banks and consultant forecasts for the carbon markets of between 50 to 250 billion in terms of the carbon markets. We've been pleased to see that there's been lots of enabling initiatives in the carbon market. So things like the ICVCM, the VCM. I won't bore you with the acronyms, but there's lots of kind of stakeholders trying to build in higher quality protocols and standards of what good looks like, and trying to hold people to those standards. There's disclosure requirements, like you mentioned, in various stages across the US, EU, and elsewhere. And I think that could be quite a soft requirement, but it will encourage more transparency and more questioning from stakeholders around what are various corporates' net zero strategies, and what's their approach to mitigating risk around some of these carbon credits that they may be using. I think the real hard push will come from pure regulation, either things like the carbon taxes or emissions trading schemes, and where the voluntary market will start to converge with these compliance markets as to whether voluntary market credit or carbon credits can be used as well as or instead of some of these emissions allowances, or instead of paying taxes. So, for example, in Singapore, there's a Singapore carbon tax, but that has some flexibility for allowing carbon credits to be used in lieu of that. There's in the aviation space, there's CORSIA, which is the carbon offsetting and reduction scheme for international aviation. That's probably the only one global regulatory regime for one industry, and that's encouraging international airlines to either build in more operational efficiencies and or use sustainable aviation fuels and or use carbon credits. So that's kind of forcing a whole entire industry on a global basis to really kind of meet a need. And that we expect perhaps there might be other industries could follow, perhaps the maritime industry, and then after that it'll be a bit more country by country specific as to how, or state by state, how they're going to implement some of these disclosure requirements and or taxes and trading schemes, etc. So I think that's where it will really see the big unlock, and that's a little bit crystal ball gazing. But I think we're all kind of moving in that right direction, and the climate pressures that we're seeing, like with the massive heat wave this week in the Northeast. It's just it's a matter of time before those types of regulations are adopted, we believe. So.
Okay, well, let's hope that we can manage to keep the acronyms to a minimum and as this market develops. And James, where online can Sustainable Finance podcast followers learn more about Kita's carbon insurance opportunities, and how can they reach you with questions they have about the topics that we've discussed in today's episode?
Yeah, sure. Thanks, Paul. So we're putting our website, which is just kita.earth. So very, very simple, or just feel free to reach out to any of myself or the team on LinkedIn, and that's always an easy route, and we're happy to set up a call to discuss further. So.
Okay. Well, thanks again very much to James Kench of Kita, and Sustainable Finance podcast followers can join me again next week for another episode. I'm Paul Ellis, and this is the Sustainable Finance Podcast.